Global markets head into the new day with risk appetite improving after investors look through the latest escalation in the Middle East. U.S. equities rebounded strongly, led by another powerful advance in technology shares, with the Nasdaq outperforming as enthusiasm around artificial intelligence and semiconductors outweigh geopolitical concerns. The recovery suggests investors continue to view geopolitical shocks as temporary unless they materially threaten the global growth or energy supplies, while falling treasury yields also provided support for equity valuations. In FX, the US dollar is trading with a mixed tone after surrendering part of its safe haven gains. The greenback continues to find underlying support from expectations that the Federal Reserve may still need to keep policy restrictive following the latest FOMC minutes, which highlighted ongoing inflation concerns and left the door open to further tightening if price pressures persist. At the same time, lower treasury yields and the rebound in broader risk sentiment have allowed the euro, sterling, and commodity linked currencies to stabilize, while the yen remains the notable underperformer as wide interest rate differentials and persistent concerns over Bank of Japan policy continue to overshadow intermittent intervention fears. Commodity markets are sending a more balanced message after Wednesday's volatility. Oil has given back a meaningful portion of its recent surge as traders judge that despite renewed U.S. Iran military action, there has not been a sustained disruption to energy flows through the Strait of Hormuz. Nevertheless, the geopolitical risk premium remains firmly embedded in crude prices, meaning markets will stay highly sensitive to any signs of further escalation. Gold, meanwhile, continues to attract defensive inflows, supported by lingering geopolitical uncertainty, even as expectations for higher for longer U.S. interest rates limit the upside. Looking ahead, markets remain caught between two competing narratives. On one side, resilient corporate earnings expectations, continued AI driven optimism, and relatively stable economic data are supporting risk assets. On the other, investors must still navigate elevated geopolitical risks, the possibility of renewed energy driven inflation, and uncertainty over the Federal Reserve's next move. For now, the market appears willing to give the benefit of the doubt to the growth story, but with volatility likely to remain elevated, incoming inflation data, central bank communication, and developments in the Middle East will continue to dictate the near term direction across FX, equities, and commodities. That's all for now.